Hi, this is Erik Epp, and today we're going to talk about combination spreads. Very quickly, a risk disclaimer which we are required to post by law. Basically, it tells you, I highly suggest you read it in fully, by the way, but it basically tells you that any trade or investment carries some risk, and you should be aware and willing to accept it. Don't use money that you cannot afford to lose. This presentation or this website is not a solicitation to buy or sell anything. We're not making any representation based on this presentation or website that you will be making any money or losses in your account. And that past performance is no guarantee of future results. So what are spreads? A spread is created by purchasing or selling a higher or lower strike call or put and selling a higher or lower strike call or put with the same or different expiration dates. There are many different kinds of spread. There is a bullish call spread, there is a bullish put spread, there is a bearish call spread, and there is a bearish put spread. And then there is combination spreads of more than one of the spreads mentioned above. So today we're only going to talk about combination spreads. So what are combination spreads? Combination spreads are spreads that are combined, such as a call spread and a put spread together. The expectation is for the stock or ETF or index or anything we buy in the option house, buying or selling an option on, is to stay within a range or only going up or down by small movements. All spreads have potential limited loss and limited profit, regardless whether they call, put, or combinations. The most common combination spread is to simultaneously open a call credit spread and a put credit spread. So here's an example of a combination credit spread. The date is December 17, 2010. We're looking at IBM, which is currently trading at $145 per share. We think that IBM will stay within a range of $120 to $150 per share in the next 4 months. The chart to show you that is on the next page. So we will initiate a call credit spread and a put credit spread based on that assumption. So here is a chart, shows you where IBM has been for the last 6 months. And as you can see from the red line, I put one just above the 120, which is basically the low for the 6 months, and at the 150, which is a little bit above the high for the past 6 months. So after looking at this and looking at the table, we decided to sell the April 2011 150, which is a strike, and simultaneously buy the April 2011 155 call spread and sell the April 11 120 put and buy the April 11 150 put spread for a net price of credit, the combination of all 4 options, of $1.80 per share or $180 per contract. Since all strikes expire on the same day, it is sometimes referred to as an iron condor. The net price is a maximum we can gain from this combination spread or iron condor. And since the spread width is $5 on either side, either 155, 150 on the call side or 120, 115 on the put side, the maximum we can lose is $3.20, which is $5 width of a spread of either side, minus $1.80 for that we got in credit. And the maximum profit would be $1, which is a credit, or 56% gain. So here is a table for the IBM options table for the April 2011. And as you can see, I circled all the different prices for the different strikes, and the green are the prices we sold, and the red is the prices that we bought. And the combination of all four gave us a net price of $1.80. So let's summarize. Combination spread summary. All spreads have a limited loss and gain potential regardless of the spread. Our expectation or assumption of the underlying stock, ETF, index, or whatever we initiate the option spread on, movement within a certain time period will determine the type of spreads we wish to create. In the case of the combination spreads, we just showed that we are expecting a movement of within a particular range of IBM of 120 on the downside and 150 on the upside. And all credit spreads require margin. In our case, because we use two credit spreads, one on the put side, one on the call side, but they were both the same widths of the spread, in other words 5 points spread on either side, the margin required will be on one side only. You don't have to pay double, you don't have to have double margin. You will be required to have margin on one side only. This is for most brokers. So please check with your broker for all the details, because this is getting a little bit too complex for this presentation. So thank you for listening to me and watching this presentation. And please visit us on the web at kissoptionpicks.com, which this presentation will be posted on. Also, you can call us toll free at 1-888-266-4137. And once again, thanks for watching us, and until next time, hasta la vista.